Hello there, Willa Ray. How's it going? Come on in. Today I'm just going to be talking about why do we trust financial institutions? Why do we trust banks? Why do we put our money in banks? Why do we put our money into 401ks? Why do we have our money into these entities? Let me get me some more light in here. Why are we putting our money in these various places and we don't have any guarantees? So that's one of the things I want to talk about today is, what is it that, why is it that we're doing these things, putting our money into places that we don't trust? We got people that have put their money to 401k plans, and they don't understand it. You got your money to a 401k plan that's only been around since the 80s. And then when people first start putting their money in 401ks, they didn't even realize that their money was actually in the stock market until the stock market crashed. When you begin to put your money into a 401k, you don't know where to put your money. You don't know what funds to put your money into. And in fact, now, if I'm talking to anybody that has a 401k, I'm quite sure that you don't even know what you're investing your money in. And then not only that, you don't even know how much fees, what your fees are. Not only that, if you've been putting money into it for a long time, you don't even know how much you paid in fees. And see, that's the thing. And just up until a few years ago, these companies these mutual funds that people put their money into, as far as the 401k is concerned, they weren't even disclosing the fees that they were charging. So, most people will pay 2 to 3% on their 401k on the fees. Now, when you first starting out, that 2 or 3% doesn't seem like it's a lot because you only have a little bit of money going in. So you go, that's no big deal. But once you start getting to the point where that you have 100,000, 200,000, so 2%, on that dollar amount is a significant amount of money that is taken away from the ability or the opportunity for your 401k to grow like it should. And then the other issue is that when we talk about 401k, we got the fee issue. The other issue that we have is taxes. So what happens is that we see that the government says, okay, I tell you what, go ahead and put your money to a 401k, and you don't have to pay taxes right now. Now, we all know that if you don't pay now, you pay more later. That's usually the way it is. If I'm going to defer it, if I'm going to defer you paying taxes, saying that you don't have to pay taxes on this money, what they're saying to you is, okay, look, we're not going to have you pay taxes on the seed. We're going to have you pay taxes on the harvest. So which one is going to cost more, paying taxes on the seed or paying tax on the harvest? But see, we think that by putting our money into a 401k before that money is taxed, that we're lowering our taxable income, and that it's going to help us. But if you look at the numbers, if you actually took your time and to do some calculations, you will see that the money that you're saving by putting your money into a 401k prior to it being taxed, within the first 3 years when you start drawing down your money from your 401k, you actually exhaust the savings. So there really wasn't any savings at all. It is better to, or let me ask you this question. Do you think it's better to go ahead and get your money taxed now? Because taxes are is at the lowest that it's ever been, that it's ever going to be again in the future, because right now we have a huge tax debt. Or so do you think we should get your money taxed now, put your money into a vehicle where the money can grow tax deferred, and then now you have access to that money tax free? Wouldn't that make more sense? I think it would make a heck of a lot more sense. What do you think? Just go ahead and pay the taxes now. Then allow that money to grow tax deferred. And we're talking about even the growth on it. Allow it to grow tax deferred. And then by doing that, then what happens is that, you can actually access, if you have your money in the right vehicle, you can even access your money tax-free. So now you've developed yourself a tax-free income. See, here's the thing. A lot of times when I get on here and I start talking about these products, people don't want to hear it because they've been brainwashed into thinking how the financial institutions want them to think. They think how the banks want them to think. Corporations want them to think. Because what happens is that they want you to put your money somewhere where you're not touching that money. Just think about it. You go back to when you're a kid. You put your money in a piggy bank. They told you don't touch it. Let your money grow. Then you graduated from a piggy bank to putting your money into an actual bank and put it into a savings account. And what do you not do there? You don't touch it, right? We don't touch that money. Go ahead and make sure you share this feed, because if there's anybody that you know that need to have questions answered, I want to answer those questions. So then we go from putting our money in a piggy bank into a regular bank. Now we know that we're not going to get regular, good interest on that money, but now we have that money into a regular bank account, a savings account, where we're getting very little interest. And once again, if we're saving for something, what do we don't do to that money? We don't touch it. We just leave that money there to let it grow. Then you go off to school or you go into a career, and people will tell you, hey, make sure they have a 401k program. So you go in, you get a 401k program, and now you're trying to put that money in there and let it sit for 20, 30 years. And they say, hey, don't touch it. This is going to be your money for retirement. Don't touch your money. So you let that money sit there for 30, 40 years, untouched, 20, 30, 40 years, however long. You're not touching it. Now, you can, of course, if there's an emergency or if you want to buy a house or something along those lines, you can borrow that money, but you have to pay it back. But they will give you, a payback term. So the question becomes, what should you do? Is there a better way of doing it? Absolutely, because they don't want you touching that money. What you have to learn to do is you have to be into a situation where you want to be able to touch your money, where you have the ability to use your money if you need to, and where you can get uninterrupted compound interest. Because that's what's important, is that you don't ever want to be in a situation where you can't access your own money, that you can't use your money, but somebody else is using your money. They're using your money and they're not even getting penalized for it. You can have your money in a 403b, a 401k, and you can't touch that money, but somebody is touching that money. Why not you? Okay. One thing I always want to tell people, if you have your money in a 401k and you ever sever your relationship with an employer, you take your money. You can roll that money into another qualified plan, because we call that qualified money. And all that means is that that money has not been taxed yet. You can take that money and now you have the ability to roll that money into a qualified plan without you having to pay taxes, which is important. You don't want to pay taxes now on that money that's been sitting there for a long period of times. Now, you may want to We do have a strategy where you can, at a little over time, roll that money out of that taxable or forever tax plan, put into something to where it's going to grow tax deferred, and then you have the ability to now pull that money out tax free. Most people who don't understand using life insurance companies for their money, most people use life insurance company for just in case they die. We want to make sure that there's money available in case something happens to me or my family members. But that's not how the wealthy use it. Now, if life insurance was just for burying your loved ones, why do millionaires and billionaires have life insurance? Because of the tax advantages that it offers. Now, I'm not telling people to go in and know everything they need to know about tax advantages. You're not going to be able to know it. But you need to have somebody that can help you to put together, whether it's your index universal life insurance policy, whether it's your whole life insurance policy for banking purposes where you can become your own bank. So user, if you're in need of a life insurance policy, you can go ahead and enter your information, and I'll be in contact with you to help get you some more additional information. That's user 465-2004-725633, and I'll definitely contact you. But yeah, life insurance is for a living. That's why it's called life insurance. Yes, the death benefit is a part of it, but that you can utilize that death benefit to help create generational wealth, or to help make your family members, your generations to come, you can make them better off. Just think about where you would be if if our ancestors had the right perspective about life insurance. Just think about where we would be if not only if they had the right perspective about that, but also had the right understanding about trust. See, these are things that we're not taught. This is information that's being kept away from us. One of the wealthiest families around, the Rockefeller families, John D. Rockefeller, said that he did not want a nation of thinkers. He wanted a nation of workers. And if you go back, you'll see that he also helped form the educational system. Why? So that we can have a nation of workers, that they can program a nation of workers and not a nation of thinkers. And so as we go through life, we're programmed to think a certain way about our finances. And anytime anything is contrary to that, we think it's a scam. We think that we're being hoodwinked. And so, come along now, we fast forward, everybody was hot and heavy on cryptocurrency, Bitcoin and all this stuff. I'm not saying anything's wrong with that. Putting your money in the stock market. I'm not saying anything's wrong with that. But if you look, life insurance companies been around for hundreds of years. You don't hear of life insurance companies failing. You hear banks failing. You hear banks failing. Matter of fact, what I'm going to do is I'm going to look at and see how many banks are currently on the wait list on the watch list. There's a watch list. There's a watch list for banks that are actually on the verge of failing. Now, here's the thing. I want you to think about this. The banks have what's called fractional reserve banking. Fractional reserve banking. What does that mean? What that means is that, and I'm just going to give you the Reader Digest version, simply means that the banks have the ability to create money out of thin air. Is infinite banking posting you do to do this live? Um, no, 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 no. It's infinite banking. No. Here's the thing with infinite banking. Here's what people don't realize. When I help somebody put together an infinite banking plan, and hopefully I'm answering your question correctly. Now, Jenny 021, do you want to come on live and ask me the question, because I don't I want to make sure that I answer your question correctly, because you're saying, is infinite banking paying you to do this live? The answer is no. No, nobody's paying me to do this live at all. In fact, if I do an infinite banking policy, okay. Matter of fact, if I do an infinite banking policy for somebody, the person who I do it for, they don't pay me. I get paid by the insurance company. And when I do put together, here's the thing. When you put together an infinite banking policy for somebody, you get paid as an agent. An agent get paid less than if he was if less than if he was just writing out a regular life insurance policy. I'm talking about 50% less. You get paid a lot less. A lot less. So why do I do infinite banking policies? I don't get paid out of the premiums. No, I do not. We get paid out from we get paid based on the premium, but we get paid from the life insurance company. You will never see the money coming from the insured to the agent. You will see the money, like a client can go into their portal and they'll see the money there. Now, there's cost for the life insurance. Now, does some of the money to pay the commission come out of the life insurance of the premiums? Perhaps it does. But most agents, when they're paid in advance. So the premium that person pays does not cover everything that we're getting paid right up front. It does not. Yep. So the thing is that, do I do this for income? Yes, I do. But that's not my main objective, because if I was going to just do it for money, there's a lot of other products that I could be writing. A lot of the products that I can be writing that will yield more money. There's times where I've had people put, thousands of dollars in the policy, and I didn't, I barely made anything, because it's not really about. I'm not really. I want to make sure that I'm a service-oriented person. I ain't gonna lie, I do want to make money, and yes, I do want to make a lot of money, but I'm not going to do that off the back of one person. You just joined. Is this for life insurance? No, I'm not only talking about life insurance. I'm also talking about 401ks, 401k rollovers. I'm talking about index universal life. But everything that I usually talk about are fixed products. And the reason why I talk about fixed products in life insurance, so there's fixed, there's variable, and then there's index. And the reason why I talk about those products is because when a person put their money in there, they can never lose. And there was a study that came out by the Wharton School of Business at University of Pennsylvania. And what they did is they did a comparison between a person putting their money directly in the stock market versus somebody doing what's called indexing, where you get stock market like gains without stock market like losses. And the indexing outperformed people putting their money in directly in the market. When a person put their money directly in the market, they get all of the gains, but they also get all the losses. When a person get indexing, they get gains up to a certain, sometimes there's a cap or a certain percentage, but they get none of the losses. So should I insure yourself or my son? Well, it depends on, here's where I look at it, Jenny. Or should I just call you Jenny? Here's where I look at it. Life insurance is like a bag of golf clubs. Each club in that golf bag is for a different reason. I'm not going to use the driver as a putter. I'm not going to use the putter as a driver. Well, here's the thing. I'm not going to say that you're wrong for not having a 401k, but you could have an index universal life policy. You could have an index universal life policy instead of a 401k. And here's the reason why. With the 401k, you could have losses. With the 401k, you have higher fees. With the 401k, you will pay taxes down the road. With the index universal life, you pay taxes before the money goes in. The money grows tax deferred, and then you have tax-free income. Okay? Yeah, it's called Index Universal Life. Index Universal Life. Now, if you have somebody put that together for you, you want to make sure that they've been doing it for a while and that they understand how to structure it so that it benefits you, so that you can get early high cash value. You want your cash to start accumulating in that as quickly as possible. Now, here's the other thing on those index universal life policies is that in the first 10 years, that's when your cost is going to be the highest. Because keep in mind, it is life insurance, so therefore there is cost involved for the insurance to be there. Because think about this. Let's say, for instance, if you're putting in $500 per month, $1,000 per month, 200, whatever dollar amount that you put in per month. And let's say, for instance, the death benefit, you're putting in $500 per month. And let's just say the death benefit is $500,000. Someone pays that $500 death benefit, $500 premium, they pass away, that's $500,000 that the life insurance company has to pay out. They've only collected $500, but they're paying out $500,000. How many times can a life insurance company do that and stay in business? Not a lot, not often. So what they have to do is they have to get as much money as they possibly can in the first 10 years. And then after 10 years, because now you have more money into the policy, the fees drop down. The fees drop down. After the 10-year, you start seeing your growth compound. So it even gets to a point where even though you're paying a cost for the insurance, that the life insurance policy realistically, when you take a look at it, doesn't really even cost you anything because of the growth on your policy. And the thing about indexing, as I was talking about the Wharton School of Business, is that you always retain your gains. When you get accredited for a gain for the year, if the next year, if the market went down, your money never went down. You never lose principal. Versus if you have your money into a 401k or 403b or any other plan like that, you actually will suffer the losses right along with the market. But with your money inside of Index Universal Life, you never lose it. But yeah, you need to have your money into something instead of just relying on inheritance, because think about this. What happens if those that you're waiting on in regards to your inheritance, what if they happen to live a long time? What if they have great longevity? What if they live well into their hundreds? That's something to think about. What happens if they live long and then something were to happen to you, but you're trying to provide for your children? You need to leave something behind for them as well. Because that's how we need to get to the point where we're passing on wealth. That's unfortunately most families don't pass on wealth; they pass on debt. I'm sorry. Oh, thank you. This is my shirt. I felt like wearing my alma mater on my shirt today. Spartan football. This is San Jose State University. I played for. This year you went to that school? Okay. I played football at San Jose State University many years ago, and I tried to get back, and I went back to a couple reunions, and actually ended up. Oh, your dad played. Okay, good. That's interesting. Um, uh, okay. Well, that's good that your father secured an inheritance for you. But now, what you have to do is look at that inheritance and now find a way for you to be able to leverage that inheritance for you to be able to make an inheritance for your son. And you can start wherever you need to start at, but you just got to start it. Um, when did your dad go to San Jose State? I'm looking up something real quick. Okay, but I had started talking about banks on the watch list because the thing is that let me ask this question here. So I have people on the line. We always talk about life insurance. Um, what do you think? What do you think banks put their money when you deposit your money into the bank? You ever thought about where banks put their money? What do you think banks put their money? Just type that in. I need some people to just kind of answer me, tell me what they think, where they think banks put their money. When you deposit your money, because we know that that they're not keeping all that money in the vault, you know. But where do you think banks keep their money? Okay, I like that answer. Heard they used our money, but never knew where it went. Good answer. Anybody else? Where do you think banks uh, keep your money? What do they do with their money? Now, let me say this. One of the reasons why most people feel comfortable putting their money in banks and don't even worry about it is because of that little thing outside the window that says FDIC, right? You know that if something were to happen, that your money, that your money's insured. Okay, now that's a good question. Do they invest it into the stock market? That's potential. Jenny, do you invest your money in the stock market? Sherelle, do you invest your money in the stock market? So we got two. Okay, after crypto, you're hesitant. Why are you hesitant? Why are you hesitant? Why are you hesitant, Jenny? And Sherelle, you said yes. Um, have you ever lost any money? Have you lost money in the stock market? Okay, that's understandable. You didn't do the research. So did you lose money, Jenny? Yes, you both have lost money. Okay, so now think about this. Now, so you, how would you feel if you went to the bank and you're depositing your money in the bank, and they told you, um, we're going to, this money is going to, we're going to put it in the stock market. Would you feel comfortable knowing for a fact that the bank is putting your money into the stock market? I'm talking about all of it. Would you feel comfortable knowing that they put all your money? Exactly. So here's the thing. Banks have to put some of their money in what's called a tier one asset. A tier one asset. And I'm just looking right now, there's over 160 banks over 160 banks on the troubled list. They may be failing. 160 banks. So they have what's called a tier one asset. So now, here's what a tier one asset is. It has to be safe. So guess what one of the tools that they use in order to make their money safe? Life insurance. Whole life insurance, permanent life insurance. Why? Because they get what you should be getting, a guarantee. So here's what they do. You deposit your money in a bank. They graciously give you 0.02, 0.03, 0.04%. Some little minute number. They give you that little bitty, itty bitty money. Okay? Then they take some of your money and they'll put it into whole life insurance. Here's a term that you can look up. B-O-L-I. BOLI. B-O-L-I. BOLI. Look up BOLI. Okay? BOLI. Bank-owned life insurance. So they'll put some of your money in there and they'll put it into a whole life insurance policy. Why do they? That's correct. Why do they do that? Because now they can turn around and borrow money from that life insurance company, because they're going to leave their money there, because they're going to get on that money that they deposited. They're going to get uninterrupted compound interest. The uninterrupted compound interest is powerful. Uninterrupted compound interest is powerful. That's what they're going to get. They're going to get uninterrupted compound interest. So they're going to put their money inside the insurance company. They're going to borrow money from the life insurance company, using the money that they deposited as they're going to leverage it. They're not going to touch it. They're going to leave that money there. That money's going to grow. They're going to take that money now. Now they can give somebody a home loan. Now they can give somebody a car loan. Now they can give somebody, they can invest money somewhere else. What they're doing is they're taking the same dollar and they're having it working in two different places at the same time. Sometimes two, sometimes three different places at the same time, depending on how they leverage it. Banks, the reason why they're on the watch list is because banks have what's called fractional reserve banking. They can take a portion of a dollar and they can multiply that dollar. Okay? Here's what I mean by that. When a bank brings in $1, depends, they can probably lend out about $10. Listen to that. They bring in $1, they can lend out $10. How long will your household last if for every $1 you brought in, you can spend $10? For every $1 that you brought in, you're out there in the stores, you're out there just having a good time and spending $10. How long would your paycheck last? It's not going to last long at all. But because they have fractional reserve banking, they're able to do that. Okay? And here's the thing. If you look at BauerFinancial.com, BauerFinancial.com, BAUER Financial.com, you will see that banks, for every dollar that's deposited, banks make anywhere between $300 to 1,400% return on the dollar. 300 to 1,400% return on the dollar. They're flipping dollars using other people's money. And only thing that they're doing is they're taking where they're putting that money first. They got that money, they got that guaranteed money coming in. You know, they're gonna get when they give you that 0.02%, 0.303% money over there on by you putting your money in a savings account, they're getting somewhere between 5 to 6% return. Right there. That is a pimp move if you think about it. They're taking your money and putting your money where you can put it and getting the interest that you could be getting and only giving you a fraction of it because we've been trained and brainwashed to put our money in the bank. Nobody has told us to put our money inside of a life insurance company. But the wealthy's been doing it for years. We wouldn't have a Disneyland if it wasn't for someone putting money inside of a life insurance policy. We wouldn't have a McDonald's. We wouldn't have J.C. Penney's. Yes, okay, here's Index Universal Life. The Index Universal Life, anybody that's looking to plan long term is a safe place to put their money, that's looking for a tax-free retirement, put their money inside of an Index Universal Life. Now, putting your money in the proper one, it gives you protection in a couple different ways. There's some of those Index Universal Life policies that they also give you a death benefit, but they also give you what's called a living benefit. A living benefit. Why? Because sometimes we get sick before we die, right? We get sick before we die. So there's some policies out there that if you have a chronic illness, critical injury, terminal illness, and now even Alzheimer's, they pay you based upon the face amount of your policy while you're still alive. So, you know, you've been putting into your policy. Something happens to you, you can no longer put money into it. Now you're still alive, and you don't, you don't want to worry about money. You can activate the living benefit portion of your policy and get money while you're still living, and now you don't have to worry about it. Okay, so now, you know, I had a client that I wrote a policy on years ago, maybe about 10 years ago, and maybe longer than that. And so what happened is that we're Facebook friends, and she was writing saying that she had some bad news that she had cancer. And so I sent a message back to her, hey, God bless you. I'll be praying for you. Hey, when you get a chance, call me. Remember, let's talk about your life insurance policy and activate your, I didn't do this on Facebook, but I sent her a text message. I said, let's go ahead and activate your living benefit. She said, what? She forgot. To make a long story short, I helped her. She filed her claim. And what she didn't realize is that right after she filed her claim, her company that she was working for let her go because she was leaving her job too much to go to her doctor's appointments. She's trying to get better, and they let her go. Because she had this life insurance policy with living benefits, she had money to take care of her. She was a single mother. She was able to take care of her and her daughter. She had a young daughter. And she didn't have to worry about going to work. She didn't have to worry about money. Okay, so that's one of the benefits. Now, and that's when we're talking about living benefits. The other thing is death. You know, if you're paying money into a 401k or an IRA or anything like that, you're paying money into it, and now you've been paying money into it for a number of years, and then you were to die, then only thing that your family's going to get is that money and less the taxes. If you're just paying into a 401k or IRA or anything like that. However, if you were paying into an index universal life, then that money blossoms into a death benefit. Okay? So they'll get the face amount of that life insurance policy. You're right, it should be called a death policy. You're 100% correct. So they'll get the face amount. So if you're putting in 500, and let's say after end of, let's say for instance, if you're putting in $500 per month, that's $6,000 per year. Let's say you put in for 10 years, that's $60,000. If a person had a 401k, the only thing their family's going to get is that $60,000 less taxes. Let's say the death benefit was $500,000. The person dies. Instead of getting $60,000, their family member is going to get $500,000. Which one works out better? Which one helps the family out more? Which one push the family in a better situation? So we're talking about if you get sick and if you die. Now let's talk about if you live too long. One of the biggest fears now is outliving your money. Outliving your money. The key to an index universal life is the power of compound interest. And then what happens is to be able to, when you look at the illustration and start seeing what happens after that 10th year to your money and start seeing how it compounds and it grows, and then it's basically you're actually developing your own pension. When a person has a pension is nothing really but like an annuity. It's really, and so basically what this is really doing is when you have an index universal life, is you're putting together your own pension plan. So the index universal life, the good thing about it is it's indexing. Your money is never in the stock market. You get to choose an index in which you feel is best. You know what? The state and educational system are basically about the only ones that offer pensions. But those pensions that they offer are really not significant. I work with a lot of people. I'm in California, but I'm licensed throughout the United States. I work with a lot of people that are in what's called CalSTRS, California State Teacher Retirement System. And majority of them always have a gap in their retirement income. And I help them to close a gap with an index universal life policy. An index universal life policy is the answer to a lot of people's questions. But there's a lot of rhetoric that comes from the financial institutions, the stock brokerage that tries to talk bad about the index universal life. You have a Dave Ramsey that talks about it. You have a Susie Orman that talks bad about them. But they're usually only two. But like I always tell them, if life insurance is so bad, if permanent life insurance is so bad, why do banks have BOLI, bank-owned life insurance? Why do corporations have COLI, corporate-owned life insurance? If it's so bad, why do life insurance companies still exist? Why do life insurance companies go through the depressions, recessions, stock market crashes, housing market crashes, and still flourish if they're so bad? See, it's the thing that gets people is they want to get you to agree. They want you to think, hey, should be able to put $1 into something and get $1,000. Typically, when you do something like that, it's going to come back to bite you. Typically going to come back to bite you. You need something that's going to give you slow, gradual growth and then start compounding and giving you great growth towards the end. And that's what life insurance does. Gives you slow and gradual growth, will give you good protection, and then it just grows exponentially. That's what's needed. Slow and steady wins the race. 401k plans have only been around for about 40 years. And if you look at the growth of the stock market, the stock market only started growing when all these corporations start embracing the 401k plans. And the reason why they start embracing the 401k plans is because what Jenny said, they took away the pensions and start having people fund their own retirement plans. They said, hey, look, we can just keep this money to ourselves. We don't have to give you a pension. Fund your own pension. Get a 401k plan. But a 401k plan was never designed or never intended to be a retirement plan. It was supposed to be there to fill a gap. See, what a person was supposed to get, a person was supposed to get a pension, Social Security, which was not going to be enough. Therefore, they could fund their 401k, and then that was going to complete the three-legged stool. So with those three, it should have been enough in order to replace your income so that you can have a golden retirement. So you can have golden years instead of rusty years. So that's the reason why, the 401k was never designed, never intended. If you even look at the creator of the 401k, he said that he created a monster. He wished that he had never. Now listen, you know this bad when the person who designed something wouldn't even use it for himself. The person, did you know the person that actually designed the 401k does not even have a 401k? You know what he did with his money? He put his money into life insurance. He calls it the 501k. Why? Because life insurance is safe. It gives you growth. It gives you protection. It can give you guarantees. There's nothing else out there. You can get with a stockbroker. He can't give you any guarantees. He can't do it. He won't do it. If you lose money with your money in the stock market, when the stock market is down like it is today, guess what? Guess what the stockbroker is going to say? Hold on, the market's going to be back. Don't worry about it. You know why they're telling you don't worry about it? Here's the reason why they tell you don't worry about it, because they're making money whether you gain money or not. Whether the market's up or down, they're going to make money. I had a client that I just helped recently that had he had more than this, but he had $600,000. At one point, he had a lot more than that, but he had $600,000 in his 401k plan that he had transferred, into some other mutual funds. He kept on telling his person that he needed to actually switch his funds over. In fact, you guys talking about Fidelity Investments? It was Fidelity. He tried to get them to switch, and for some reason they didn't switch. He lost money, and we took that money from being forever taxed or forever paying fees to never having to pay fees again. Fees, whether it's 1%, 2%, 2%, just add up 2% on $60,000. That tells you how much he was paying per year in fees. 2% on 600,000. That's a lot. So the thing about it is simply this: is that now I see the comments on Fidelity. So you're saying that Fidelity have guarantees? What are Fidelity's guarantees? Because I'm not familiar. I'm gonna be honest with you, I don't know everything. What are Fidelity's guarantees? None. Right, exactly. Well, I can tell you of a guarantee that Fidelity has. I can tell you a guarantee. The stockbroker's going to make money, whether the market's up or down. Now, here's the thing. Um, do you guys remember the commercial years ago? I don't know how many people are close to my age, but anybody familiar with E.F. Hutton? E.F. Hutton? EFHUTTON? You guys recall that name, E.F. Hutton? When E.F. Hutton talks, people listen. Remember that commercial? Okay, so here's what people don't realize. E.F. Hutton was a stock brokerage company. They were stockbrokers. But do you know what E.F. Hutton was talking about in that commercial? E.F. Hutton was a stockbroker. Do you know what he was talking about in that commercial? Are you ready for the answer? He was talking about life insurance. E.F. Hutton was whispering life insurance. He wasn't giving people the latest stock tip or the latest best stock to put your money in. What E.F. Hutton had found is he had found in the IRS codes that there were ways in which people could put money into life insurance, receive guarantees, get growth, and they didn't have to worry about losses. So what happened is that E.F. Hutton had all these people that were going to their stockbrokers and pulling money out from their stockbrokers and was putting money into life insurance products. They would take $50,000, or let's say they would take $100,000 and they would put in a $50,000 life insurance policy. That's what I said. $100,000 cash inside of a $50,000 death benefit. So they had more money inside of the life insurance policy than the face amount of the policy. But the people were getting a good return. They were getting, they weren't having to worry about any losses. So it was a good investment. There was no risk involved. So why wouldn't they do it? Well, what happened is that there's this term that's called run-on. So there was a run-on stock brokerage companies. People were actually going to their stockbrokers, pulling their money out, and taking it and putting it into life insurance policies. So this was happening in massive scales. So these stock brokerage companies went to the IRS, and the IRS said, hey, they must be doing something wrong. So the IRS went to E.F. Hutton and said, E.F. Hutton, you guys are doing something wrong. E.F. Hutton said, no, it's within your tax codes that a person can do this. So the IRS didn't agree with E.F. Hutton, so they took him to court. IRS took E.F. Hutton to court, and E.F. Hutton won. The IRS lost. So guess what the IRS did when they lost? When they lose, guess what they do? They change the rules. So the IRS came back and said, okay, look, when you give out a life insurance policy, life insurance companies, you got to do it based on a person's age, their gender, and their health. Age, gender, and health. It has to always look like life insurance. Also, there's going to be a cap. there's got to be a corridor, a gap between the cash that they have going into the policy and the death benefit. You can never have more cash in the policy than the death benefit. If you ever do that, it becomes what's called a modified endowment contract, which is basically the same as an IRA or 401k or 403b. It's the same as. So we call that a MEC limit. So based upon this ruling, there were some changes, TEFRA, DEFRA, and TEMRA, basically stating how fast you can put large sums of money inside of life insurance policies. And the reason why they was doing that is specifically in order so there would never be another run on these security companies, these stock brokerages. But that goes to show you how good life insurance, putting your money in life insurance products are. That E.F. Hutton, he was a stockbroker. He was doing it. So I want to thank you guys for being on here with me today. Before I get off, because I do have I have to meet with the client here shortly. Any questions that you want to have answered, if you want to get in contact with me, there's a form there that you can complete, and I'll be more than happy to have an opportunity to talk to you about any questions. Now, once again, there's people on here that has met with me before. I'm no pressure. My thing is that I'm truly transparent, and if I can help you, I'll help you. If I can't help you, I'll let you know that I can't help you. I don't try to force you into anything. I help educate you so that you can make an informed decision. Okay? So you're welcome. I'm glad that I was able to give you some great information there. What I do is I make sure that I educate myself. I go through a lot of training in order so that I can help my people get the best information. But I'm also smart enough to know that I'm not the smartest guy. So I have a team of experts at various companies that I employ in order to help me help my clients. So, I utilize some of the best and brightest minds to make sure that I can help my clients, and not only do I have access to them, but I also have access to, CPAs and attorneys and things of that nature. If I just need to ask a quick question, I do that. And I learned that in my years of coaching. I didn't have to be the smartest coach, but I just need to have smart coaches around me. And I have smart people around me. So hopefully there was something that today that you heard that's able to help you. And I ask that if I can help you, contact me, and I look forward to talking to you soon. Once again, I'm Carlos Millsap, and I thank you for spending some time with me today. God bless you. Bye-bye.